The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, Chief Market Strategist for NexPoint, and welcome to our weekly market deep dive for May 17th, 2021. Well, starting with some of the big movers last week, you can see the strength in commodities we'd been seeing in corn in the bottom right, copper in the bottom center, and the Bloomberg Commodity Index overall has finally gotten extended and looks like it's out of gas. Specifically looking at corn, after up weeks of 12, 10, and 9%, corn finally fell back to earth, down 12% on the week. Now, these moves are normal. If you look at the chart of either copper or the Bloomberg Commodity Index, you can see what I've termed or highlighted to be a flag pattern on the chart. Typically, the leg out of these patterns is the same as the leg in, and after hitting their targets, it's very natural for the commodity index, copper, and corn to just take a little bit of breather and digest these gains. Looking at the big picture, and what's a little more important, the US dollar is down, testing important, if not critical, support in the 90 area. You can see it here on the weekly chart in the top center, but you can also see it on the monthly chart on the top left. This area has been support over multiple years, and should it break, it could literally ignite a pretty vicious round of inflation. We're not predicting it, but again, this is an important, if not critical, area to watch for the US dollar. Also important last week, which was despite or in spite of the weakness in commodities, the gold and silver markets remained quite firm. We've mentioned those the past couple of weeks as well as opportune entry points into those markets. And if you were ever interested in hedging a portfolio with some precious metals or some miners, this really is a good time. We particularly like silver over gold, as you can see by the silver gold ratio, which has been trending higher. And you can also see as gold has consolidated or corrected over the last 3 quarters, silver has shown good relative strength by really just going sideways and creeping its way higher. The bottom line being the US dollar is at a truly critical area of support, and reflation could turn into outright inflation if it breaks. Looking a little deeper into both oil and gold with Brent crude on the left, I'd like to focus on this dashed rectangle on the left-hand chart. The point being, the bottom of the chart shows the difference between the 1-month and the 12-month futures contracts in Brent crude. And you can see that we're in a healthy backward type environment in the oil market. Additionally, price has gone through a downtrend line, or broken out, as we like to say, and pulled back quietly to test that breakout successfully. So again, the oil market looks to be in healthy shape and one that wants to go higher from here. Gold, you can also see breaking its downtrend in both dollar terms and euro terms in the bottom of the right-hand chart. But more importantly, the spreads between the 5 and 10-year break-evens and the yields has been moving up over the last month. It was off slightly last week, down 2 pennies and 3 pennies respectively on the 10 and the 5. But in general, the strength over the last week also supports the up move in gold. Looking at bonds in the US interest rate market, it was really a pretty quiet week last week. The important move was the Friday before, which we have circled on the daily chart. And you might remember Friday a week ago, the US government was expecting 1 million new jobs. The report actually came out with 266,000, falling far short. That pushed yields down to the 147 to 148 area, which is right on this first Fibonacci level. These levels are areas where markets typically hold once they're in a pullback. Clearly, we've had a strong trend in yields. Yields are now pulling back, and it was a very natural spot for this to hold. So last week, interest rates really just traded in the range they've been in over the past several weeks. But stepping back, this is a strong trend that is being consolidated in an orderly manner. Looking at yields globally, I'd like to first focus on the US interest rate curve or yield curve on the bottom left. The point being, this is the yield curve this week, a month ago in the olive dotted line, 6 months ago in the green dashed line, and 12 months ago in the gray dashed line. The point being, you can see over the last year a steepening in the yield curve, just a different way to look at it compared to the previous slide. Rates around the globe last week really just reversed what they'd done the week before. The week before, the US interest rate or the US 10-year yield was lower, and those in Japan, Germany, and the United Kingdom were higher. And last week, the US was higher, while those in Japan, Germany, and the UK were lower. So again, really consolidative sideways action going on in the yield markets around the globe. Most importantly, you can see the 10-year US break even continuing to make higher highs. And that's important because it's the US 10-year that led everything higher off the COVID lows last year. Looking at credit spreads, or the difference between the US 10-year and either investment grade corporate bonds, high yield corporate bonds, or triple C corporate bonds, like the yields globally, last week's action really just reversed the week prior, meaning last week we saw investment grade widened by a basis point, high yield widened by 6, and triple C widened by 24, which were essentially the reverse of the week prior when spreads were narrower. Stepping back, you can see spreads are not flashing any major warning sign. Often spreads widen materially before a sell-off in stocks occurs, and you can see a very benign environment for credit at this point. Looking at the big picture of the market cycle with our value line slide, you can see several market cycles here with the bottom in 02, bottom in 08, bottom in 11, bottom in 16, our bottom in 18, and then of course our COVID bottom last year. Based on the chart at the bottom, which is the percentage of stocks above their 200-day average, we believe we're in an emerging bull market and one that's in the early innings of the game. We measure that based on whether this indicator is above or below 40%. And while a lagging indicator, it does a good job of identifying those major turning points. What we're going to focus on this week, however, is the fact that the percentage of stocks above their 200-day in the value line index slipped below 80% for the first time in many months. This indicator was above 80, again, for an extended period of time, which is healthy longer term, but over the near term suggests stocks may finally be nearing the type of correction that pulls it back to its moving average, as you can see in these red arrows. Looking a little more tactically with daily charts on the left, you can see that the daily charts have gotten quite oversold. If you look at the S&P, you can see the stochastic oscillator is oversold. You can see the stochastic on the NASDAQ is oversold. And both of these markets are trying to carve out short-term bottoms. The S&P is also bouncing off its 50-day average. And you can see that the NASDAQ is weaker because it's been going back and forth between that 50-day average for some time. You can also see that internals are starting to decay by the advanced decline ratio on the New York Stock Exchange, going below 5-to-1 negative last Wednesday, as well as the number of new 52-week lows on the NASDAQ. Prior to March, you could see when the market was at 14,000 the first time, or the NASDAQ composite, the internals were dominated by a large number of new 52-week highs and really no new 52-week lows. While that is the same situation, or still the situation on the NYSE, the NASDAQ has started to see a significant number of new 52-week lows creeping in the market. So even though the average is at the same point, and if you look at the papers and you see 14,000 back in February and you see 14,000 here in May, you think, well, that's just about the same. It's really not the same because the character of the tape or the market internals are really very different on this second test of 14,000. Finally, on the daily charts, I have included a Bitcoin index, which we don't usually show, but the reason I show it is because Bitcoin is widely believed to be a good indicator of the speculation in the market, as are some other indices. And if you look at that chart, you can see it's been going sideways for several months and what looks to be building a head and shoulders top. So while we think Bitcoin may be a great long-term investment, it certainly looks vulnerable over the short term here, particularly if you break this neckline we've highlighted here. Looking at the weekly charts, certainly the market isn't a confirmed bull market. If you look at the NYSE, breadth and leadership remain strong. But again, if you look at the NASDAQ, you see a advanced decline line making lower highs or diverging, and a number of stocks making a new 52-week high diverging as well. So again, when you compare the NYSE to the NASDAQ is suggesting stocks may be headed for an extended correction here over the near term. Looking at market sectors, you also see a bit of a defensive picture last week. When we sort the groups by performance, we see that the top performer on the week were consumer staples, very defensive group. Utilities were not close behind or not far behind by only losing 20 basis points. And that's a very defensive tilt to the tape. You can also see that the value ETFs handily beat the growth ETFs. That's been a theme for several weeks now. In some cases, the value ETFs were actually in the green when the growth ones were in the red. So again, a pretty marked shift of value over growth. And something I'd like to focus on this week is the relative strength, or in this case, the relative weakness of the tech sector. If you look at the top left chart here where we write XLK, this is the technology sector ETF, which is in a strong uptrend, right? Solid uptrend, pretty far above its 200-day or 40-week moving average. That being said, if you look at the performance relative to the S&P 500, which is in the center here, you can see that we're finally starting to see a pattern of lower highs and lower lows, meaning weak relative strength in technology. Now, that's not something that is the start of a bear market by itself, but again, whereas technology clearly led the market off its lows for the first 4 to 5 months of the rally off the COVID lows, technology is now lagging as other sectors are starting to outperform. Well, it's good news that the outperformance is coming from financials, as you see the green line trending up, and basic materials and industrials. But again, it's underperformance nonetheless, and something we think is important to note. If you look at the change in the volatility surface last week, we've got the volatility surface of the SPY on 514, or last week in the top left, the week before in the top center, and the difference on the right. So this mountain chart on the top right is the difference between these two curves. The point being, volatility shifted up last week, as you can see, really across the board, particularly on the near-term option expiries. The point being, market participants are getting increasingly nervous about a pullback in the market and are starting to really bid up the price of puts and calls. When you look at the individual sectors, you can, of course, see that's the case as well, with the put call skew trending up on the Russell as well as the NASDAQ over the past several weeks, and call skew trending down over the past several weeks. But you can also see it in interest rates and the high yield market. Again, high put call skew, high put skew, low call skew, which again signifies a market that thinks rates are going that direction. The energy and financial ETFs are beacons of hope and safe havens at this point. And you can see, again, call skew remaining strong on energy and financials, and put skew weak in energy and financials, as people try and rotate out of technology and into energy and financial stocks, which are much more of a value tilt at this point. Finally, looking at the overseas markets, we've taken a little bit different of a look this week in that we're taking a 2-year weekly look at just developed emerging markets, several developed emerging markets, as well as several emerging markets, the DM on the left and the EM on the right. We will again show next week the weekly charts of those indices on the far left. The point I wanted to make this week is with a little bit longer look back, you can really see how strong these rallies have been. We all know the German DAX has scored an all-time high recently, but it's really a little different perspective when you look back at those COVID lows in March of 2020 and see just how far that market has come. The EWQ, or French market ETF, you can see a wonderful uptrend there as well. The UK ETF is a little bit weaker, no surprise, given the Brexit situation. Japan is clearly leading the way higher, as is the South Korean ETF. Regarding the BRICS, going from the top right, you can see China led the way higher, is now pulling back and trying to hold its 40-week moving average as defined by the MCHI ETF. The A-shares ETF, which represents the Shenzhen and Shanghai exchanges, is a little bit stronger in that it's actually bouncing off that 40-week moving average. The Indian ETF is strong as well. Russia is just breaking out, and the EWZ or Brazil ETF remains stuck in a range. So again, a little bit of a mixed picture, but you're definitely seeing strength in the market being led by Asia. Finally, we like to look at our COVID slide once a week, and there were some interesting data points on it this week. First of all, as you can see in the top left, cases and deaths, of course, remain very, very muted and mild, which is great news. And of course, why CDC Director Walensky eased mask guidance last week, which is good news for everybody. If you look at the chart just below where we have a point B, that shows the difference between COVID cases in mask-wearing states and states that don't have such strict mask guidance regulations. So maybe this is what she looked at to see that masks weren't really helping that much. If you look at the top right, TripAdvisor has published some statistics on their searches on their site for hotels, experiences, and restaurants, which are all up significantly since January 1st. D shows the percentage of US population by segment which have been vaccinated. And you can see the most vulnerable segments are reaching 80% vaccination rates, which is great news. Interestingly, the chart on the bottom left shows that if you have received a vaccine, you are actually less likely or less comfortable, we should say, engaging in normal pre-pandemic activities. Specifically, if you look at going to restaurants, getting on an airplane, going to a party, going to a wedding, whatever, people who have been vaccinated are less likely to be comfortable in those environments than those who have not received a vaccine. So clearly, if you're afraid of COVID, you're afraid of COVID even with a vaccine. And if you're not too concerned about COVID, you're not too concerned about COVID even if you don't have a vaccine. Very interesting study. In summary, the US dollar is testing a truly critical area of support around 90. This could be the leading domino going forward on many, many market trends, both commodities, interest rates, and stocks. So far, yields do remain healthy. They've gotten back through 140 on the long-term charts, and they've really been digesting those gains in a healthy, orderly manner over the past several weeks. As for credit spreads, they remain low, healthy, and a tailwind for stocks. No warning signs there at all. Stocks appear to remain in a long-term bull market, meaning one that lasts several years. Typically, a market cycle is 35 months long, meaning we're probably in the third, fourth inning of the game. That being said, within that second year of a bull market, you often see some pretty significant corrections, some pretty significant consolidation ranges, and the NASDAQ continues to warn that that's where we may be headed over the short term. As for the overseas markets, they also remain in healthy, longer-term uptrends. They're being led by Asia, and it's good news that the Chinese markets are still holding those areas of support. Finally, in the appendix, I do have a quick slide on gold and silver. That was the exact slide from last week, which has not been updated, but I wanted to have it there for reference. I've been Mike Hurley, Chief Market Strategist for NexPoint with our weekly deep dive for May 17th. If you have any questions, please don't hesitate to reach out to us or your representative, and we do hope to see you next week.